Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance. And today, oh boy, do we have a juicy one for you. We're diving deep into Manhattan Associates' annual report, the 10K for the year ending the 31st of December 2025. And let me tell you, there is a lot to unpack, from soaring revenues to some interesting strategic moves. Before we jump in, if you love getting the real scoop on what goes on behind the scenes at big companies, make sure you hit that subscribe button. And hey, for more insider chats and to connect with fellow corporate explorers, join our Discord community. The link is right there in the description below. Alright, so what is this document all about? Think of this as the annual checkup for a publicly traded company. Manhattan Associates, a leader in supply chain and omnichannel commerce solutions, laid it all out for us. They're telling us how they did financially, the risks they see, and where they're heading. It is essentially their report card for the year. And we're going to see if they aced it or if there are some red marks in there. Let's kick things off with the big number everyone cares about: revenue. For 2025, Manhattan Associates raked in a cool $1.08 billion. That is up from about $1.04 billion in 2024, a modest 4% increase. Now, while that might sound like just a small bump, remember this is a company that has been around since 1990, and they are a serious player in some pretty complex markets. The story behind that 4% increase is where things get more interesting. The real star of the show here is cloud subscriptions. This category brought in $408 million, a whopping 21% jump from the previous year. This tells us people are really digging their cloud solutions, and it now makes up 38% of their total revenue, up from 32% last year. This is a huge win for Manhattan Associates because the future of software is definitely in the cloud, offering a more predictable and flexible service for customers. They also mentioned about 96% of their total software revenue comes from the cloud. That is massive. It means they're really leaning into this model and moving away from the old ways of selling software licenses. Speaking of old ways, software license revenue actually dipped by 2% to about $14.8 million. This is a clear sign that while they still offer licenses, the market is clearly pushing towards subscriptions. It is like selling a car versus offering a car subscription service. The latter is becoming the preferred choice for many. Then we have services revenue, which includes all the expert help they provide with planning and implementing their software. This brought in $503 million, but it actually decreased by 4% from 2024. It seems that while cloud revenue is booming, the services side saw a bit of a slowdown, likely due to customer budget constraints. This is something to watch, as services are a big part of their overall revenue pie, making up 47% of the total. Now, you can't just make money without spending some. The cost of delivering these cloud subscriptions, maintenance, and services went up just slightly, by about 0%, staying flat at around $471 million. This is pretty good management considering their revenue grew. It means they are efficiently delivering their services and keeping a lid on immediate costs compared to their revenue growth. Where are they putting their money to grow? Well, they are investing heavily in research and development, spending $145 million in 2025. That is a 5% increase from 2024. This shows they are committed to staying ahead of the curve in the fast-paced tech world, especially with new innovations like artificial intelligence. They're not just talking about it, they're investing in it. To get those cloud subscriptions and services out there, they bumped up their sales and marketing spending by 7% to about $81 million. This makes sense as they are pushing their cloud solutions hard and need to reach new customers and expand relationships with existing ones. General and administrative costs saw a 4% increase, reaching about $94 million. A good chunk of this increase seems to be related to hiring a new chief executive officer, with a signing bonus and other related costs. It is common to see a bump here when there is a significant leadership change. So after all the revenues and expenses, we get to operating income, which is pretty much the profit from their core business operations. This came in at $280 million for 2025, up 7% from $262 million in 2024. Their operating margin, which is how much profit they make for every dollar of revenue, improved slightly to 25.9% from 25.1%. This is a healthy margin, showing they are good at managing their business. Now let's break this down by region. The Americas still bring in the most dough, with $810 million in revenue, a slight 1% increase. MEA, which includes Europe, the Middle East, and Africa, saw a stronger 13% jump in revenue to $216 million. And the Asia Pacific region, or APAC, showed good growth with a 12% increase to around $55 million. This global spread is a good sign, showing they aren't solely reliant on one market. Looking at operating income by region, the Americas remain pretty much flat year over year, indicating slower growth or maybe higher costs in that region. However, MEA saw a significant 21% jump in operating income, showing strong profitability there. APAC also showed a healthy 11% increase. This suggests that while the Americas are their largest market, EMEA is becoming a real profit engine for the company. The big story across all regions is the growth in cloud subscriptions. Americas saw an 18% increase, EMEA a strong 28%, and APAC an impressive 48% surge. This confirms that the shift to cloud solutions is a global trend, and Manhattan Associates is capitalizing on it everywhere. Now, let's talk about the company's financial health. As of the 31st of December 2025, Manhattan Associates had a very healthy $329 million in cash and cash equivalents. That is up from about $266 million the year before. And the even better news, they have no debt. This strong cash position gives them a lot of flexibility to invest in their business, acquire other companies, or return value to shareholders. Their cash flow from operations was strong, generating $389 million in 2025, a nice jump from $295 million in 2024. This means the core business is generating plenty of cash to fund its operations and investments, which is a really positive sign for stability. What are they doing with all this cash? They've been actively buying back their own stock, repurchasing shares worth $315 million in 2025 and $286 million in 2024. This is a common strategy to boost shareholder value. They also replenished their share repurchase authority to an additional $100 million in early 2026. Showing continued confidence in their stock. Now, no company report is complete without talking about the risks, and Manhattan Associates has its fair share. They are worried about undetected errors or bugs in their software that could damage their reputation. This is a pretty standard concern for any software company. They also highlight the risks associated with storing customer data, emphasizing that any breach could hurt their brand and lead to legal trouble. Given the increasing threat landscape, this is a critical area for them. One specific risk they are grappling with is the rise of generative and agentic AI tools. They are using these tools for their products and internally, but they acknowledge the uncertainties. They worry about protecting their own intellectual property if their developers use AI to write code, and also about their customers being hesitant to adopt AI-powered features, especially in regulated industries. This highlights the evolving nature of technology and the challenges of integrating new tools responsibly and effectively. A major dependency for Manhattan Associates is their cloud subscription revenue. If customers decide to stop subscribing or reduce their use of professional services, it could significantly harm their business. This underscores the importance of customer retention and continued innovation to keep those subscriptions rolling in. The company also acknowledges that staying competitive means constantly advancing their technology. The software market moves incredibly fast, and they must keep innovating to avoid their products becoming old news. This requires ongoing investment in research and development, which they are doing, but there is always the risk that these investments might not pay off as expected. Finally, no corporate deep dive is complete without a look at legal matters. Manhattan Associates is currently facing a couple of putative securities class action lawsuits and a shareholder derivative lawsuit. These are still in early stages, and the company denies the allegations, but these kinds of legal battles can be costly and distracting. It is a reminder that even successful companies can face significant legal headwinds. So, what is the verdict on Manhattan Associates' 2025 report? They are a solid company that continues to grow, especially in the crucial cloud subscription space. Their revenue is up, their cash position is strong, and they have virtually no debt. They are wisely investing in research and development, particularly in AI, to stay ahead, however. They are not without risks. Dependence on cloud subscriptions, the ever-evolving tech landscape, and ongoing legal battles are areas that demand careful management. The slowdown in services revenue is also something to keep an eye on. Overall, though, Manhattan Associates seems to be navigating a complex market with a clear strategy and a strong financial foundation. They are a company that understands the need to adapt and innovate in the software world. Alright, that is our breakdown of Manhattan Associates' latest annual report. What do you think about their cloud push and their investment in AI? Let me know your thoughts in the comments below. If you found this analysis helpful, give it a thumbs up and subscribe for more corporate deep dives. And remember, for more in-depth discussions and a chance to connect with other finance enthusiasts, join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next one.